Is the bond market going to be the reason for the next financial collapse? Hey, everybody, welcome back to another beautiful day in real estate. We're going to be diving into the bond market because the bond market right now is extremely unsettling. Everything is extremely uncertain right now, and we're starting to see investors actually funnel into short term bonds, which is a very bad sign. So before we jump in, the bond market has been starting to show cracks for the last couple of years. And in the last 6 months, it's accelerated extremely to really showcase the fact that we have no stability across the United States, across the world as an economic whole. So today we're just going to dive in real quick, talk a little bit about oil, and then we're going to dump into the bond market and explain a little bit what's been going on. So first off, oil prices. So this morning I woke up. The first thing I saw this morning is that U.S. and Iran have extended their 60-day ceasefire that was set to expire today, which really hasn't been a ceasefire. There's been shots on both sides of the spectrum, but it does show a little bit of positivity for the market, whether we want to admit it or not, whether we call, Trump the taco man or whatever, it doesn't really matter, because when you see stuff like this, it's positive for the market, whether we as a personal investor care or not. The market itself is more than likely going to see oil prices come down slightly. It's not going to be a humongous drop. We're not seeing the end. Like those days have kind of come and passed as far as saying, "Oh, we have a peace deal," or we're extending the peace deal, because it doesn't. Like at first, it held a lot more value behind those words. Now that value is a lot less, right? So it doesn't mean that there's none, though. So just by seeing something like that, you're probably going to see the U.S. bond market, the oil market, excuse me, actually take a little bit of a dip and a dive today. And we've talked about that. We've talked about that on multiple separate occasions, because we've seen this negative, not negative, but this downward trend, right? We've seen, and I'm on the weekly, let's bump back to the daily here, but you can clearly tell that we're seeing a straight downward action. And again, oil not pushing above this support or resistance again is going to actually show positivity for the oil market, because if it doesn't push above, which with this news more than likely won't, and not only that, but look at the stochastic. The previous stochastic RXI was way oversold for a time. It didn't even break above 70, and when it doesn't break above, or 75, 70, there we go. Anyways, it doesn't break above that top of that channel. It's not very good news. Typically, if you're a trader, you're going to be looking at a potential short somewhere along the lines here. And the same concept here, right? We saw a higher high and then a lower high on the RSI. So from a charts perspective, it shows that we're more than likely going to see some downward action. And as the market opened this morning, we're not even seeing that much volume pushing it up, right? And this is WTI crude oil. Now, same thing with Brent crude oil. Same exact thing is happening. A little bit of a different channel, but more than likely we're going to see a push downward again. Again, higher high, lower highs, right? And volume is starting to come off again. And this is the spot Brent crude oil. So this actually structured to see something like this on Monday. This is not something I'm not too surprised at. I was expecting to see oil prices kind of come down again. I think the days of pushing up are a little bit closer to over right now. There's more concerns as far as fertilizer and other products, not just oil. See, we've been so focused on oil that we've neglected to go over the bond market for quite some time. So before we get too into the video, let's just dump into the bond market right away. So this bull theory on X has actually got really, really good info. He explains it very well. But basically, there's no stopping Japan's economic crisis. For those of you that don't know, Japan has been rising interest rates from nearly zero for basically the last year and a half, and they're raising it on every single meeting. Why? Well, they're raising it because their economy is so weak right now. There's no stability. And for a very long period of time, Japan had low interest rates near the zeros. And now that they're starting to hike rates, it's really bad for the economy across the world. Japan's 2-year bond yield hit 1.692%, the highest level in 31 years. It was negative in early 2024. That's a rise of nearly 175 basis points, so 1.7%, from below zero in just 2 years. The 5-year is at 2.17, also a 31-year high, and a 10-year is at 2.92 at a 30-year high. The entire curve is repricing at once, not just the short end. Japan already carries debt worth 205% of the GDP, while Q2 GDP growth came in at 1.1%, annualized versus 2.0. So I have another one in here, a short one, but basically what happened is the economy is not growing right now, right? They have no money flowing in and out. And this is not just Japan, but Japan is such a staple to the bond market. They've been holding a lot of U.S. equities for a long time. U.S. came in and said that we're going to actually prop up the market, and it didn't even barely make a dent. And that is what is very concerning. See, we've been talking about a market crash and everybody was so focused on real estate. Don't get me wrong, real estate is a little bit tougher right now. You're seeing homes sit on the market a lot longer. You're seeing less traffic. And I believe it said on one of the articles I read this last weekend that 50% more sellers than there is buyers across the country. So the housing market is weakening. I mean, I was wrong. I thought that we were going to have a very strong year this year. I expected interest rates to come down, but as we live and learn, we start to see that's not the case, right? So right now we're seeing a lot of money flow into, or I shouldn't say a lot of money, but we're seeing a lot of highs in the bond market for Japan. All right. Now let's talk about China, right? China's 10-year bond yield has crashed 7% in one day. This is a move you rarely see in government bonds. The yield fell from 1.339% and fell to 1.33%. It was at 2.52% at the start of 2024. Money is piling into government bonds because there's nowhere else to put it. Property is still broken, demand is weak. The stock market is still down 36% from the 2007 peak. Investors are locking in at 1.33% for 5 years because they expect things to get worse, not better. People are putting money into secured bonds, and like, this is China, so a little different, but we saw inflation at 3.2%, I think was the most recent. I can't remember all the numbers anymore. But if you're putting money into something like this, granted, again, let's just separate from China. Let's talk about the United States. In order for you to beat inflation and actually make money on your money, you have to be above that 3%, right? And that 3%, in my opinion, is a very skewed number, right? It's very cherry picked out of the niche, right? So when they have bond, or when they talk about inflation, people don't really realize there's a huge catalog of product, right? You can go anything from energy to oil to I don't even know, food, vegetables, like anything across the board. It could be cars, it could be houses, and they pick the lowest numbers, they mash them together, and they say, all right, inflation's at 3%. In reality, more than likely it's higher than that. But that's a whole nother tinfoil hat for another conversation. But what's happening now is that you're seeing money go into bonds because it's the only thing that they feel confident in, which means that we could be leading towards a very big financial crisis, especially when they're focusing on the short term. I think I had the next one here. Let's see. Okay. So bond market crisis hitting the entire world. Bloomberg global long bond yield has surged to around 4.2%, the highest since 2008. Long-term government borrowing costs are now back to levels last seen in the global financial crisis. With governments carrying far more debt today, higher yields are making refinancing increasingly expensive. This is becoming a major pressure point for the global financial markets. So this is, again, and I'm going to bring up blockchain again, this is why I am so focused on the blockchain side of things, because liquidity is a massive issue right now, right? We have money flowing and it's mostly borrowed money, which is another concerning factor. AI is extremely overhyped, and I know people are going to shoot me for this, but dude, there has to be stability, and there is none. This market has ran so hard. I mean, let's just pull up the S&P 500 for 1 second. So the S&P 500, you guys, has been running like this because 20% of the S&P 500, right? So 100 companies are AI-based companies, and they're the reason that it's holding up the market. Everything else is very uncertain, and this is considered and could be considered a blow off top, right? We saw this channel. We've talked about this channel before. This channel goes all the way back to 2007. We've only broke above this once, and that was in the peak of the bull market in 2021, right? We saw the major head or shoulder pattern, and then it went down to crash all the way down to October of 22, where the market bottomed, and then we started moving back up again. But as you can see, if we zoom out, let's go to the weekly chart here. I always touch on this because it's so important. Look how long this channel is, right? Look, it starts the bottom of 2009. March 2009, when the market's basically flattened out, and it's been on a steady tear ever since. Breaking above this is good for the short term, but it shows me that there's a blow off top happening. Why? Because the markets are about to see some of the most brutal days it's seen since 2008, 2000, 1980s. The market is set for a massive correction. And I don't care who the president is. I don't care. People point fingers and blame the presidents. Like, it's always, Biden had inflation high, Trump is pushing this. It doesn't, like, it matters, but it doesn't, because for the last 50 years, we've been following this pattern. For the last 100 years, we've been following this pattern. And now we have currency that's devalued to basically nothing across the country, across the world. Most of these countries that, especially even first world massive countries, are squeezing themselves because they don't have the stability anymore. The money's not worth anything. There's no confidence across the world. You have wars happening. You're seeing poverty. You're hearing arguments about, fresh water being an issue, AI data centers being built. Like, we're on the transition from the old world to the new world. And that is where a lot of us get so confused. We're hyper-focused. We don't want data centers in our community. We're hyper-focused. So the stock market's doing good, so everything must be good. We're not opening up the broad picture, and the picture needs to state that what we're looking at is a tiny pea hole of what's actually happening. So this right here, although good in the short term, expect blood in the streets. And that's why people are moving into the bond market, because right now the stock market is oversold or overbought. The stock market is stronger than it's been in a long time. We can't sustain a vertical action up. And that's, again, something that every young trader makes. I've made that mistake. I made it far too many times until understanding and taking a step back. And the last thing I'm going to touch on, the rally in U.S. stocks is being driven by borrowed money. For more than 4 million SpaceX call options traded on Tuesday at all-time highs, beating a May record by 10%. The same week, the S&P crossed 7,700 for the first time, and the VIX fell to the lowest level since January. But this is not bullish at all. When someone buys a call, a dealer sells it. The dealer is now short the market and has to buy S&P futures to stay neutral. So the index goes up because dealers are hedging, not because investors are buying stocks. This is a very important thing to pay attention to. They're borrowing and leveraging money again, right? And the reason that they're leveraging the market is because they feel they know the next move, right? More calls get bought, more hedging happens, the index goes higher. The move keeps feeding itself. The falling VIX adds to it. Funds that size positions by volatility automatically buy more when the volatility drops, whatever the price. Korea just showed how this ends. And Korea had a massive crash. And I don't have that news article in front of me, but it had a massive crash recently. And it dropped overnight. I think we saw a 7% decrease this morning in bond pricings. Like, that's insane. 1% is a big move. 7% is absolutely astronomical. So right now, the bond market is definitely a very concerning place to be. And it's not even from the perspective it's not good to put your money there. It's the perspective of, why are people putting their money there? Why are people putting their money into something that's stable, that's barely beating inflation, because they don't have confidence in anything else? We saw gold run, silver run, we've seen the S&P run, and as you can see, partially S&P's running again. And I didn't even know this until I read that out loud, but because they're leveraging the S&P and they're filing futures. When they're filing futures, they're leveraging more money. They're pushing more money and more volume into the S&P 500, which is pushing it up. There will come a time when that will stop. And when that stops, people are going to be holding their dicks, and they're going to wish that they sold some. This is the problem with young investors, or investors as a whole, is we see the portfolio going up. I see tons of older couples that are retirees that are living after retirement that don't want to buy homes right now because there's uncertainty, and they see that the market's going up, so they want their money to keep going up. But what they're not paying attention to is what happens in every single push in a market like this. The market runs, you see it blow off top, it peaks, everybody starts to get scared, and then the whole market comes in and sells at once, and it crashes the market. But not even the stock market, bond markets are going to be such an important and valuable piece to this that we need to be paying attention to. So as we keep going through this, I'm going to keep diving in, providing the articles, and starting to keep focusing on the bond market, because this is really going to be a dictation of what the market and what the economy can look like over the next 5 years. Right now, things are not as good as people are seeing on the stock market. People are struggling. People aren't making ends meet. Houses are slowing to sell. People are borrowing money to try and leverage themselves. People are in credit card debt, foreclosures. They're losing their jobs. Like, this is a clear sign that the market is starting to become weaker and weaker by the day. And whatever a president says, and he screams at the top of his lungs, stock market's doing great, the average American is not. And the thing is I saw an article the other day. I think they said 6 out of 10 or 8 out of 10 people making over $300,000 a year are living paycheck to paycheck. Now, that does correlate a little bit about how pricing is, but it also correlates and dictates how we utilize our money. It showcases how many people utilize their money so poorly. And people say, well, no, everything's expensive in the bigger cities. Sure it is. I'm sure it is. But when you have a brand new car, a high mortgage, when you're paying excessive amounts for your phone, you have streaming services, you're going out to eat every day, coffee every morning. Like, we are spending money so poorly. I invest as much as I possibly can. I just leverage my house so that I can build an inventory home so that I can start generating some cash flow other than in the stock market investing in something along those natures. This is what you need to be paying attention to because the stock market is going to come down at some point. You need to start learning how to hedge your money somewhere else where it's going to be stable, at least generate some sort of a percentage, because every time you let your money sit in your savings account, it loses value. Every time inflation comes above zero, you're losing value in your money. So that's what I have for today. Pay attention to the bond market. It's getting uncertain. Pay attention to the S&P. Pay attention to what's actually happening, and more than anything, interpret everything with a grain of salt, because right now everything seems very untruthful. But anyways, that's what I have for today. Thanks for watching. Have a beautiful day. We'll see you soon.